more sharply than expected.
As you said, there's lots of uncertainty in the UK economy on the upside and the downside.
There's going to be a housing crisis.
So in this video, I'm going to tell you what is starting to bite, which some have claimed may cause a collapse in the UK property market, and why the full impact on this might not be felt on the market yet.
You never really remember the beginning of a dream, do you?
So, I need to understand if this really is the end of the home ownership dream.
They feel real while we're in them, right? It's only when we wake up that we realize something was actually strange.
Well, by the end of this video, you'll have to figure out which story really reflects reality. So the reality is that the average house price in the UK has a value of about $258,000 in January, down from $262,000 a month earlier. That's about £1,000 decline per week on average. The nationwide data shows this is the 5th straight month of downward pressure on the housing market. But is this the end of the trend? Perhaps this is just another blip, or maybe the opportunity to buy into the market that some have been waiting for. After all, the Bank of England have come out and suggested there might be less pain than expected in the economy going forward. You know, is this just a typical doom-mongering from the media and economists? Let's be honest, those guys never have anything good to say. So the key thing we need to look out at the first level is property chains. And this is simply where you need someone else to complete their transaction as a part of completing yours. You're in a chain. The problem is, if you're stuck in a chain, it can cause everything to stall if the housing market dries up. So this is a big problem. Hampton's data shows that in 2022, a record 73% of buyers were chain free, from a low of 65% in 2010. Well, here's the thing, the number of buyers pulling out of property sales and collapsing chains has risen sharply over the past 3 months, as high mortgage rates and fears of recession are starting to really take hold for the property market. Property portal Zoopla found that the percentage of properties returning to the website within 2 months of having been marked as sold subject to contract rose 6.4% in November, the highest level in 3 years. So what's happening here is the first time buyers who used to drive the market are now no longer there, which is causing these chains to stall. But to understand why this happens, we have to go deeper.
Their hopes for prosperity, for home ownership, now under threat.
So to go deeper, we have to understand the next link in the chain, and this is all around affordability. That's a continuation of the dramatic hikes we saw in 2022 as central bankers globally tried to combat inflation. The base rate drives the mortgage cost, and how much you can borrow for a mortgage depends on how much you earn and how much the borrower is expected to take up of your income. This is already having an impact on mortgages, and we can see that mortgage approvals are falling off a cliff, over 20% down from last month. So what is happening is that first-time buyers in large numbers are no longer able to afford to buy the properties they used to only a matter of months ago. As this chart shows, the number of approvals for home purchases was lower as prospective buyers struggled given high mortgage rates. With mortgage rates still above 4%, a house price correction could be very likely. But to understand how affordability is connected to all this, I need to show you this. This is the predictors of if house prices are expensive or cheap relative to history, and the servicing cost of debt, within the pink where the UK houses are overpriced. Now, fixed rates at the end of 2022 were somewhere between 5 and 6%. They are coming down, now somewhere between 4 and 5%, as they've walked back some of the pain from the mini budget. When we model prices compared to mortgage rates, this model predicts, and I reinforce predicts, that we're seeing a range of between 40 and 50% overpricing.
On the edge of collapse, and some have failed. As uncertainty has grown, many banks have restricted lending. Credit markets have frozen, and families and businesses have found it harder to borrow money. We're in the midst of a serious financial crisis.
In order for a person to afford a house, they'd have to get a mortgage against their income. Though house price to income levels had started to grow, in 2008 we went into a new era of monetary policy. Central banks were so scared about falling into the next Great Depression, they did everything they could to try and fix this. And look, their logic was simple and arguably correct. All we have to do is solve the problem from where it originated: lending. They felt the only way they could give the banks the confidence to start lending again, flooding the system with easy money. Low interest rates and quantitative easing, or QE as it was called. So QE involves the central banks buying bonds to push up their prices and bring down long-term interest rates. In turn, increases how much people spend overall, which puts upward pressure on the price of goods and services. In total, the Bank of England bought £895 billion worth of bonds. Most of these were UK government bonds, but the remaining £20 billion were UK corporate bonds. This had a huge side effect of causing asset price inflation. After all, if financing costs are cheaper for everyone, this will find its way into the system, and this helped spur a rise in UK house prices. Now that balance sheet support is being reversed. But the problem was for housing, this locked in generations into a chain, a generational chain. The baby boomer generation, who were the ones who owned the majority of property at the time, benefited hugely from the asset price inflation. The generations prior to them were now stuck with low wages from joining the workplace during the Great Financial Crisis. But there's only one thing that might be able to keep this housing market afloat, despite financing, despite all the pressures. And to understand this, we have to go even deeper.
The subconscious is motivated by emotion, right? Not reason. We need to find a way to
One thing that drives everything, and it could well be the reason that you've clicked on this video. Look, despite what I've said, we remain a nation hung up on home ownership. It's a very British thing, and our overseas friends, they simply don't get our fascination with mortgages and living in a property that we own. Do we as a nation have an unhealthy fixation with our home being part of our social identity? And in a way, is pricing not relevant to that? The French have even coined the phrase, the English disease, which refers to our intense obsession with the property market. The thing is, if you look back all the way to the 80s, starting with the Tory drive for home ownership, generations whose parents were just filled with the reality of being able to upsize every couple of years as the norm, wealth being made on the back of over-leveraged buy-to-let investors. And when you add to that the social pressures and our supply issues, is it even possible that there'll be an actual house price collapse? Look, whether you agree or disagree, this ethos has been supported by politicians, and how our view of status has been driven by home ownership over the past couple of decades. So while there are many, many reasons to think we in the UK are dreaming, I'm not sure whether it's going to collapse down on us.
They feel real while we're in them, right? It's only when we wake up that we realize something is actually strange.